Ah, tax season. Just hearing those two words can be enough to make you a little stressed out, right? But here's the thing. Getting started really doesn't have to be that complicated. In this explainer, we're going to demystify the very first steps of preparing to file your U.S. income taxes. We'll break it all down into a clear, manageable process. Okay, let's jump in.
So when you think about filing your taxes, what's the very first thing that pops into your head? Is it digging up a mountain of receipts, firing up your calculator, or maybe just wrestling with some confusing tax software? Well, what if I told you the real first step is something else entirely?
That's right. Before you even touch a calculator or open up a single program, the most crucial step is just getting organized. It's all about gathering your information first, because that simple act lays the foundation for an accurate and, let's be honest, a much less stressful tax season. And the best place to start gathering your data might actually surprise you. It's not with this year's documents. No, it's with last year's tax return. Seriously, you should think of it as your roadmap for the journey ahead.
And this isn't just some friendly advice. It's serious business. Reviewing an old return is about finding and fixing mistakes that could cost you big time. For example, in the source material, a tax pro named Leslie found that her client, Mark, had reported a stock sale all wrong on a previous return. Catching that little error saved him a whole lot of trouble and money down the line.
So, what are you actually hunting for in that old return? Well, you're looking for these little golden nuggets. Things like carryovers. These are benefits like investment losses or tax credits that maybe you couldn't fully use last year, but that you can apply to this year's return. They can directly lower the tax you owe. It's literally like finding money you didn't know you had.
All right, next up is something absolutely fundamental: your identity, at least in the eyes of the IRS. And this all comes down to your taxpayer identification number, or what they call a TIN.
Think of a TIN as your personal barcode for the IRS. It's the unique code they use to track all of your tax stuff. Everyone on the return, that means you, your spouse, your kids, any dependents, every single person needs one. No TIN, no tax return. It really is that simple.
Now, these TINs basically come in two main flavors. Most of us are familiar with the Social Security number, or SSN, but for folks like foreign spouses or dependents who need to file but can't get an SSN, the IRS issues something called an Individual Taxpayer Identification Number, or ITIN. It's important to know it's for tax purposes only and doesn't give anyone permission to work.
So, what if you or a family member needs an ITIN? Don't worry, the process is pretty straightforward. You can mail in the application, which is Form W-7, along with your tax return. Or, and this is a great option to avoid mailing original documents like a passport, you can work with a certified acceptance agent, or even visit a designated IRS center in person.
Okay, so you've got your data, you've got your ID numbers. Now let's talk about the clock. Because when it comes to taxes, timing is everything. And believe me, the IRS is very particular about its deadlines.
For most people in the U.S., April 15th is the big one. We all know that date. But there are some key exceptions. If you happen to be a U.S. citizen living abroad, you automatically get an extra couple of months, until June 15th. Need even more time? Well, anyone can request a 6-month extension, and that pushes your filing deadline all the way out to October 15th. And for some people abroad, there's even a special extension to December.
But, and this is maybe the single most important thing to remember about extensions, so listen up. An extension gives you more time to file your paperwork, but it does not give you more time to pay the tax you owe. You still have to do your best to estimate what you owe and send that payment in by April 15th if you want to avoid penalties.
And speaking of penalties, let's look at what being late actually costs you, because this is where the procrastination can really start to hurt.
So the IRS has two main penalties, but whoa, they are not created equal. The failure to pay penalty is 0.5% of your unpaid tax each month, but the failure to file penalty, that's 5% per month. It is 10 times more expensive just for not getting the paperwork in. That's a huge difference.
This is the key takeaway, the bottom line. Because that filing penalty is so incredibly steep, you should always file your return on time or file for an extension, even if you don't have the money to pay your bill. Filing on time and paying whatever you can will always result in lower penalties than just doing nothing.
Let's put some real numbers to this to see the impact. In this example from our source, Hannah filed 3 months late and owed $6,000. Look at this. Her failure to file penalty was $810. The failure to pay penalty was just $90. Add in some interest and her bill jumped by over $1,000, just for being a few months late. Ouch.
All of this really points to a core principle of the U.S. tax system. It's a pay-as-you-go system. The whole idea is that you're supposed to pay your taxes throughout the year as you earn income, not all in one giant lump sum in April.
So how do you know if you've paid in enough to keep the IRS happy? Well, thankfully, they give us what are called safe harbor rules. Think of these as your get-out-of-jail-free card for underpayment penalties. If you meet just one of these conditions, you're generally good to go.
So here's how this plays out in the real world. You've got Emily the freelancer. She paid in 90% of what she ended up owing for the year, so she's safe, no penalty. Then there's Gilbert. His income jumped up, but he was smart and paid at least 100% of what his tax bill was last year, so he's safe too. And finally, Yvonne, who owed less than $1,000 when she filed. She's also in the clear. See? As long as you hit one of these targets, you're fine.
Now, there is one little catch to that 100% rule, a little bit of fine print, if you will. If your adjusted gross income, your AGI, is over $150,000, you actually have to pay in 110% of last year's tax to be in that safe harbor. It's a small but really important detail for higher earners to remember.
So there you have it. From gathering your data and checking those old returns, to understanding TINs, deadlines, and how to avoid those nasty penalties, these are the real first steps. See, it's not about being a math genius, it's just about being prepared. Hopefully this makes the whole process feel a lot more manageable and a little less scary. So the real question is, are you ready to get started?